It's Wednesday, June 28, 2023, episode 7 of the new Market Huddle Plus. I'm Patrick Ceresna. This week, we have the pleasure of welcoming back to the show Pinecone Macro's Chase Taylor. We're going to do a talking chart session discussing the S&P 500, German yields, natural gas, oil, coca, and rice. Quick disclaimer, nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much market huddle may include backwardated viral loads, adjustable rate virus variants, and boxed wine motor malfunction. Let's get Chase on the call. So joining me now is Chase Taylor. How you doing, bud?
Doing great. How are you?
I'm doing great. I'm looking forward to chewing some crayons with you, buddy. I had to just start off with this S&P 500. I mean, here we had almost everyone convinced we were going into an economic recession. So many people bearishly tilted on the markets. And yet here in the month of June, we just saw an extraordinary rip higher in these markets. And the bull trend continues even right now, in spite of my natural bearish inclination. This looks like a bull flag to continue higher. What's your take on these markets and what do you think is next?
Yeah, so I wish I disagreed on the chart, but it does kind of look like a bull flag. But the funny thing is, we've had the recession that hasn't happened yet. But at the same time, the Fed was supposed to raise until they broke something. Then they broke at least a part of the banking system. And then a bunch of liquidity followed that up. And that liquidity has really helped levitate the market. So the Fed breaking something kind of backstopped equity markets. And obviously now with volatility as low as it is, you're getting a lot of vol control flows just kind of steadily coming in, which also dampen volatility. That leads to more volatility flows, but it looks like we're close to being done with that. So between that and liquidity falling, at least some, moving forward, it might be tough for this bull flag to really go rip to a new high, I think.
So do you think that the summer is going to be more like a doldrum topping formation type development, or do you think that there's risks that if, let's say, we have a bad jobs number in July or August or a poor earnings season, that we could already be breaking on the downside? Do you have a bit of a bias?
Yes, that downside. And I think late summer it's very possible that happens. I've been kind of saying, people might have to cancel some usual summer vacation plans this year. And I do think earnings will be a part of that, although I think that's going to get worse more in the second half than the second quarter earnings. But I think the consumer is a lot weaker than people think. And so I think a lot of the wild extrapolations for consumer health as that plugs into earnings in the second half and into 24 are going to be very disappointing for people.
Well, let's quickly just touch on Fed funds. Obviously, the Fed's been raising interest rates, and in spite of a pause, they've been signaling that there's still room for more rate hikes. Obviously, they don't want a rate cut cycle being too aggressively priced in. What's your take on where we are in the interest rates and everything from like money supply and credit?
Yeah, so I think they have over tightened, and personally, I thought that since really they've moved past about 3%. I really think inflation's mostly dead. It's just a lot of the super lagging stuff like core that still has to kind of come back down to earth. But anything forward looking you look at inflation wise, it's going to happen. So the problem with the Fed is they kind of look out the window while they're making policy, even though what they do affects policy a year from now, and what they're staring at was really a year prior. So it's just, that's why they always make policy mistakes, go too far in either direction. I think they're going too far again. But on that money and credit side, you mentioned it's really been a focus of mine. Obviously, a lot of people like to throw around the M2 year over year chart, and it looks horrifying, and that's too scary, and it's not that bad. But if you look at just kind of M2, the actual levels, and then maybe just month over month, I think that is starting to look bad, and you're about a year away from being back to trend. And I think if you let that go below trend, that's a big problem. And on the credit side, typically in a cycle, credit is a lagging indicator. You have economic problems, and then banks tighten up lending. But this time, the economy is still doing pretty well, and credit's tightening because banks don't have the money anymore. So it's kind of an awkward situation where credit is leading the cycle, which is going to mess up everyone's cycle analysis, possibly including my own. But to me, that is a very concerning side of everything that's going on now, is having tightening credit before the economy itself breaks. So you could have the economy start to break and job losses start to pile up at the same time as credit is already bad, I think that could be kind of a double negative for the back half of the year.
Right. You know what's interesting. Okay, so to collaborate that and then to talk about something that isn't confirming that, overall, the financials have been awful. They've been laggards, and even though they're not necessarily breaking down to lower lows using the XLF, you look at some of the investment banks like a Goldman Sachs is like breaking those May lows. It's already in a distribution cycle even before the earnings, and so that kind of collaborates, I think, your view. But what I'm trying to figure out is how is it that these home builders can keep ripping? I mean, you basically have mortgage rates just skyrocketing on the upside. You would think that would stifle the home demand, but yet these numbers just continue to just blow out month over month, and these home construction stocks are ripping like it's a new bull market. Like, how does this end?
Yeah, I think poorly, but the interesting thing is higher rate hikes, and higher rates is really what it's basically herded everyone into new homes because no one's selling their existing homes. So it's like this awkward situation where higher rates led to everyone having to buy a new home. So on the flip side of that, it's kind of weird, but probably the worst thing for home builders will be a rate cutting cycle and job losses. Job losses, and then all of a sudden, people with existing homes, it's not really a choice anymore. You have to sell it, and you're starting to see some of that where more than 30-day delinquencies. They're still low, but they're starting to move. And obviously, we're having jobless claims starting to move higher. So whenever jobless claims gets above, say, 300K, and then you start having red non-farm payrolls, which I think is possible in about August, then all of a sudden people have to sell homes, and existing supply can start picking up as rates start to fall. With that, those sales can start picking up, and then people have choices. They don't have to go after new home construction, and then the builder's backlog just collapses, and I think that's when this goes bad. But I'm in the group of a lot of people that didn't really see that coming, even though now it's really painfully obvious that it would work that way.
Yeah, it's sometimes it's just so easy to you look at this chart and say, well, I should have just listened to the technicals, right? Like it
Exactly.
stayed above all of its moving average, all above all of its trend lines. Everything was working. It's like, but I just didn't want to drink the Kool-Aid, and clearly, it's one of those things that we had Tony Greer come on to the Huddle Plus, and he was very bullish to home builders. I'm thinking, my God, like, is it really got more gas in the tank? Like, I mean, it's been a great move, and he's been right. Like he's been on this the entire time, and just enjoying this ride. It's unbelievable. Nonetheless, let's move on. I want to talk yields. And because the 10-year yield more or less hovering around 375, and it's basically been a 1-year purgatory, basically a trade range between 340 to 440. Well, I'm just making up a rough range, like a 1% range, and we're pretty much right in the dead center of it. What do you think is the next big move in interest rates from here?
I think the next big move's down, and I've been saying I thought we could get to 2.5 before the year's up, and I still think that's possible. And really, that's just mostly a recession call, and thinking that jobs will have to break at some point. I think people have taken a lot of the one-off stimulus and extrapolated it into the future when it comes to what we're going to be looking at for retail sales and earnings. And I think whenever they have to start recalculating those realities, then you can have yields go down on a recession.
Yeah, I've taken a little more of a conservative approach, which I said I thought the highs of the year were in for the 10-year yields, as opposed to calling for a big breakdown. But I generally am in the same camp as you. This call is becoming a big echo chamber for me and you. But anyway, let's talk though about the German yields, and this is interesting because you wanted to highlight what's going on in Europe here, and the 10-year yield in Germany has more or less been hovering around 2.5% also for most of the year. What's your thinking here?
Yeah, and on your chart there, if you go from that low in August and kind of do an uptrend line, it actually kind of broke below it yesterday, and today is kind of like retesting the bottom of it. So I think we're actually starting to see the very kind of end of this. So I mean, Europe, just like the U.S., is over tightening, and but unlike the U.S., they haven't been adding liquidity. They've been truly letting liquidity run down while tightening. And obviously, we had the German data come out this week on like the way businesses are thinking about everything, and PMIs, and it's all just brutal. So, and we're in this weird situation where the U.S. growth is slowing, European growth is slowing, Asia isn't like really stepping in. We have a lot of malaise coming out of China, so none of the three major centers of growth are doing much. So it's very difficult for someone like Germany that depends on trade. But even even Italian yields look worse than German yields. So you have a situation where the risky bets from the European sovereign side are even looking better from a buying the treasury standpoint. So I think yields pretty much globally have a long way to go down. Pretty much any developed market, bond market looks like a buy to me. But I think maybe the best at the moment is going to be boons. I just think they're ready to break.
So now I'm going to put you on the spot in terms of call, like, because I generally agree with you, but my view has been that we're not going back to the where yields were pre-COVID, right? Like, I think that we're not going to see negative rates again. And while we had this big move and we have an economic recession, that could we see interest rates half from here, like go from 240 down to 120 on the German bond? Sure, I could see that, but I don't know if I want to get so bullish on bonds looking for another major rip. Are you far more bullish than I am, or you think it's just going to come off of the highs like that?
No, I think I'm probably a little more bullish, but only because I think the over tightening is going to be like on severe policy mistake realm that would allow yields to go maybe back to, I don't know, 75 basis points, 50 basis points even. But I agree with the overall sentiment, whether it's U.S. or Europe, that like we're not going all the way back to that. Inflation's not going to go all the way back to the old baseline. The new baseline, I do think, is higher for inflation and for yields both. But during just one cycle, like where you can bottom out, can still be incredibly low, I think.
Well, let's move on though to the impact of what that will have on the European currency, on the euro. Now, typically in the intermarket relationships, at least over the last 3-4 decades, whenever we go into some sort of a risk-off impulse, you have the U.S. dollar typically act in a safe haven element and do well. Do you think that emerges again in this cycle, or do you think it's a little bit different this time?
No, I think at least early on, cyclically, that's what you're gonna get. And I think the euro's kind of, just looking at it, looks to me like it's kind of putting in a bit of a head and shoulders top. And because they are kind of even making a bigger short term policy error, I think you can have that just kind of cream the euro short term, and that's going to obviously push the dollar up, and clearly the ends of no help for keeping the dollar down at the moment. So yeah, I think the dollar is going to have probably an impulse move higher in the early innings of this. But at the same time, like, I also have a very dim view of U.S. Real economy in the second half of the year, so it's very hard to feel good about being bullish the dollar. But when I look at the euro and think about, hey, at least they're draining liquidity too, and they're doing it really fast. I think they're more afraid of their inflation situation at the very moment than we are. So it just feels like they might push theirs over the edge a little faster than we do. And then next thing you know, yeah, the euro's back flirting with parity.
All right. Well, let's talk commodities, bud, because I know that you love to forecast some commodity moves. I want to start with the big boy in crude oil, and this chart, like, we've been in a downtrend in crude oil essentially for over a year now, it's incredible seeing just the persistent weakness here. What's your current stance on oil?
So for me, I still love oil medium term, but I've been bearish for, I don't know, months now, and really I mean, I whenever OPEC decided to cut, every time they cut, I just get more bearish personally. To me, it's a sign of weakness, and adding a bunch of spare capacity is not a good thing. To me, I want to buy oil whenever they're adding production and they're confidently adding production, not when they're cutting it. So I'm still bearish, but at the same time, if you think about what oil's had thrown at it with new supply coming on from everyone from Iran to Venezuela, um, Russia not cutting the way we all thought they were going to, it's just been oil's pretty much had everything you could imagine thrown at it in the last few months. So it's definitely building itself to be a great trade at the bottom of the cycle, but I think whenever you have growth slowing essentially in every corner of the world, and especially in the US and Europe, you're not going to be able to take off during that environment. So I think US recession, you probably have another leg lower, maybe into the 50s, possibly even 40s, but then after that, it's going to bottom out. And as the economic cycle turns, you're going to have kind of the next inning of a really, really strong bull market.
Yeah, well, listen, I agree in principle in a sense that this has been a clean downtrend. It's incredibly bearish price action. And, when you look at this chart, it just feels like the next move is lower. I'm just not as bearish in terms of downside targets. The interesting thing that I think about is, will we see it play out? Obviously everyone is selling oil in anticipation of this global economic slowdown. What if it ends up playing out that it's the sell the rumor, buy the news, where once we have some true economic data that confirms that a global economic recession is truly underway, that oil literally bottoms into that release. At least that's a speculation. I don't know if I want to stand behind it too strong, but it would be interesting to see whether that kind of a development happens.
Yeah, and what I would say is like I'd be confident buying, 25, 26, 27 contracts into that because they're already. I mean, I'm happy to buy them now. I mean, they're so cheap. So even though I'm bearish, like out years, I'm still happy to buy here. And as they get cheaper, I mean, you're talking about buying oil 2-3 years in the future for the 50s, and that's really attractive if you think you can go back to 100. And I don't think there's any question we can.
Oh, for sure, and the term structure just helps you. You go out farther out like that, you're locking it in lower contract prices, so you at least have that backwardation working for you, right? The What I wanted to talk to you about is these energy stocks quickly. As again, it's an awful looking chart, like lower highs, very distributive. Every rally's failing. Do you anticipate that these energy stocks will distribute on the downside during that oil cycle as well?
Yes, and I think part of that's just going to be general equity market beta, just following everything a little lower. But obviously, they're not getting the flows or anything either. But yeah, I think they're going to have to go lower before they bottom out. At least on the oil producer side. Different story on gas for me, but on the oil producer side, I think they're going to have to go make newer lows. And the other thing I will say is, I do think some of the offshore services can hold up better, just because even with the downside and spot oil prices, the money they're getting on their services contracts for rigs and stuff they're still so strong that they can. I think they can weather it a little better. Will they have some downside? Sure, but I think they may be able to weather this stuff better.
Yeah. Well, let's talk the Widowmaker. Let's talk some nat gas. Now, what a devastating bear market decline it had over the last year. I mean, from $10 down to $2, basically. Obviously, I'm rounding, but just a devastating 70-80% drop from peak to trough. And nat gas is really finally just everything quieted down. It's the last 3-4 months. While I have here the July contract that only has a few more trading sessions left before it rolls to August, but it really, for the first time, we're seeing that break of that pattern of lower highs and lower lows and heavy distribution. Where are you at with nat gas? What are you thinking here?
I love it. And kind of like I was talking about earlier with oil, I had so much thrown at it. I think that's the same story with gas, where you had a mild winter, you had an LNG export go down by 20-25% for a sustained period of time. All that allowed inventories to really build up in the U.S. So now you have the situation where a hot summer or a cold winter can really start to drain. You're going to go right back to LNG, hitting all-time highs on the export side. It's funny, when we're up near $10, people were talking about banning exports, and we're going to run out of natural gas. And the next thing I know, whatever it was, 8 months later or something, you're seeing headlines about nat gas maybe having to go negative because we're hitting tank top on gas. And it's just kind of hilarious to me how those things work. And whenever I saw those headlines, I knew I wanted to get more involved. And I've been going with the phrase that summer is the new winter, because the electricity demand during the summer is so big, and especially when gas is cheap and people can just use gas instead of coal. It just makes for really heavy power burns for gas during the summer when it gets really hot. To this point, we've had some heat in Texas and a little bit in the kind of lower Midwest, and a little in the Southwest, but we haven't had any major east of the Rockies, whole East Coast, Mid-Atlantic like heat waves. And I think that's what you really need to see this kind of rip up to like 4 or 5. But I do think that is possible this summer to go hit a 5 handle.
Well, the key here, and I think it's important to emphasize, is like the seasonality of nat gas is always priced into the future. So you have every winter gas contract is always trading at a premium to the summer gas. And the thing here is like already we're going to get a roll up towards $3.50 to $4 just as we roll the term structure forward on the continuous charts, right? So you're thinking here that we're going higher even on those winter contracts, right? Like, so here I have the December 2024 nat gas contract, which about $4.20, which is several dollars higher from where we currently are trading. Where do you think something like this long dated December contract could go?
Yeah, so that's obviously next year. So I think before that thing expires, it could even touch 10 again. Obviously, a more reasonable take would be say 7-8, but I'm long a lot of the December 24s, and because I think they can double from here.
Well, make sure any listeners that follow that have some ulcer medication for the volatility that comes with that. All right, let's. But there are. When you're playing it through equities, I know you wanted to talk some of these individual stocks. How are you playing nat gas through stocks?
Yeah, a few names. Range Resources, RRC is one of the favorites, and they do a lot of nat gas liquids. So even in times when gas itself does bad, if propane's okay, which it's not right now, but if it's okay, like they can kind of lean into those liquids. But it's one that looks like it's kind of in a bull flag itself, and maybe wants to break above that. And to me, it looks like it's bottomed out of late. And a lot of these names have really behaved well, considering we went from 10 back to a 2 handle. I've been impressed by this. I've been impressed by EQT, which really during the last bull cycle wasn't that impressive. But now, like, yeah, exactly. You had like really in the last 2 weeks, I would say you had a lot of consolidation at some new like little cycle highs, and now we're kind of trying to break above that. So it's a chart I really like.
The one thing that kind of concerns me about that is a lot of times these nat gas stocks get lumped in with a lot of energy companies into these ETF baskets. And if we do see oil weaken and a lot of these energy stocks, beta 1 to the downside with the market, will these nat gas stocks be able to have enough buy flow to be able to, stay buoyant, or will they get dragged down with everything else? That's just the kind of question that's on my mind when thinking about these.
Yeah, it's a good one, but to me, like I hope so. Like I would love to see it get drugged down by something that's not fundamental, so I could buy more of it.
Oh, there you go. All right, quickly, we have time for 2 more things. Coca futures, what a bull run that's been happening here. What's your thinking?
Yeah, so this is one we actually got right. November of 2022, we sent out a monthly letter all about cocoa. It was a deep dive primer and bull case. Really, it really came down to was we thought we'd go into an El Nino and that would have create a lot of crop problems. And sure enough, that is all played out, and that's what we're seeing. And I think rice is kind of the next in that story. Rice and sugar could both have some significant issues as El Nino wreaks havoc on Southeast Asia going into the rest of the year and into next year. So I think you got to get out a little bit, maybe like March of 24 to really make this thing work, something like that. But I think rice production could be a problem out in Southeast Asia and India. Indian weather could be a significant problem also for sugar. So I think looking at some of the a little off the beaten path ags can be beneficial moving forward. But even here in the U.S., looking at things like corn and wheat, I think can have a significant run. Especially you look at the crop health being as bad as it is at this point. If that kind of holds in through July, then we're in big trouble, and corn and other grains are going to go way higher.
Oh, listen, Chase, I love talking charts with you. Hopefully you come back and do this again with me. But before I let you go here, can you just let all our listeners know where they can find you and what you do and how they can follow your stuff?
Yeah, absolutely. So now these days, since I've been on the show, I wear two hats. So I'm at Bulwark Capital Management. You can just Google Bulwark Capital, be the first thing that comes up. I'm the head of research there. And also, obviously, everything's still at Pinecone Macro Research, and you can find that at pineconemacro.com. And on Twitter, just Pinecone Macro.
Well, awesome. Chase, thank you so much for joining me, buddy.
Thank you.
Well, thanks for tuning into the Market Huddle Plus. We appreciate you spending some time with us. And listen, we can never have too many friends. Bull market or bear market, we're just happy to spend some time together on this crazy ride. So cheers, everyone.